Good morning, everyone, and thank you for joining me for the first SURF webinar of 2022. My name is Eva Majorova, and I look after investment consulting at Sygnia Asset Management. On the agenda for today, I will quickly cover the default investment strategy of the Sygnia Umbrella Retirement Fund, and then I really want to summarize 2021. It's January, we've just started a new year, so let's summarize what really happened in the markets in 2021, and then of course, how did this affect the performance of your portfolios? So under the performance analysis section, we will look at both the performance of the markets as well as your portfolios. And lastly, I want to give you some insights as to how we are positioned for the year ahead, how we're positioning the portfolios for 2022, and I'll touch on some of the risks that we are staying mindful of at the moment. So jumping straight into it, just a reminder of why we really created this very innovative product. The Sygnia Umbrella Retirement Fund is a very innovative retirement fund, and really it was created to be able to restore some confidence in the retirement fund industry, and ultimately our vision is to be able to enable life-changing and dignified retirement outcome for all of our members. In terms of an investment strategy, every management committee of every participating employer would have a choice with regards to what the default investment strategy would be. So it's always a life stage model, which is implemented by the Board of Trustees of the Sygnia Umbrella Retirement Fund, but then each employer chooses one of the three options available from the life stage models. In addition to the life stage model, where members would be defaulted into certain portfolios according to their age, members do have member investment choice. We do understand that not everybody's circumstances are the same. Some people would prefer to retire later or earlier, or maybe, immigrating. So there's many reasons why somebody may want to opt out of the life stage model and choose their own investment strategy. So there's a number of portfolios that you can choose from. There's no limitations as to when you can and cannot switch. So you can switch at any time of the year, and we will not charge you fees for actually switching the portfolio. So I mentioned that the default strategy is a life stage model. So the way this life stage model works is that members are defaulted into different portfolios according to their ages, with your younger members being defaulted in portfolios that are a little bit riskier, a little bit more aggressive, and they have a higher allocation to equities, which is shares. The idea is that the higher the risk, the higher the return. So for younger members that can stomach the volatility and the market cycles that we experience in investment markets, it's suitable to be invested in a high equity portfolio. So any member from the time that they enter the working world right up until 6 years before retirement would be defaulted into the 70 portfolios. The 70 portfolios have about 70% invested in equities. As you get closer from 6 years to retirement, closer to 1 year before retirement, as you get older and older, closer to your retirement date, you start being transitioned from the 70 portfolio to a mix between the 70 and 60, then the 60 and 50, etc. Until 1 year before retirement, you are invested in the 40 portfolio that has only about 40% invested in equity, implying that the other 60 are in a safer type of asset classes such as bonds and cash. So the idea really is to de-risk as you get closer and closer to retirement. So that's the structure of the life stage model. But each employer, so the management committee of each single participant, can choose whether they want to follow the passive and active blend, or the actively balanced life stage model. The passive one being the skeleton range, which is totally low cost passive, utilizing only passive strategies in ETF. The signature range is a blend of active and passive management, and the synergy range is predominantly active on the local side, where we have South African active managers, and on the global side, you have the passive components. Looking at the difference from a construction approach between the skeleton and signature range and the synergy range, the skeleton and signature follow this diagram on the left, which is what we call a specialist approach. Sygnia controls the asset allocation, and the asset allocation is known upfront. So depending on our views of the markets and depending on what the portfolio is actually trying to achieve, every portfolio has a strategic asset allocation, which is the long-term asset allocation, the long-term portfolio construct. And there's a predetermined number that should be invested in equities, a percentage that should be invested in bonds, a percentage in global equities, so across all the asset classes. And once we've decided exactly how much should be in equities, we then look for the best equity managers or the best passive strategies to be able to implement on that decision. And that's why if you follow that little diagram, you see you start with a portfolio, then depending on what you're trying to achieve from a CPI plus objective and our current views on the markets, we'll decide, for example, 48% needs to be in equities and 13% needs to be in bonds. And then we go and find in the skeleton range, the passive strategies that can assist us in implementing that decision. And in the signature range, it would be a blend of active and passive managers. The balanced approach, on the other hand, which is the synergy range, you start with your portfolio. If you follow the diagram, you then divide that portfolio between a number of asset managers, and you outsource that decision to these asset managers on whether where they would like to place the fund's assets. So within the restraints of Regulation 28, it is up to them where whether they want more equities or a little bit more property or a little bit more bonds, cash, etc. So that decision, that asset allocation decision on the local side is outsourced to them. The offshore portion of all three ranges is passive and managed by Sygnia Asset Management. As I mentioned a little bit earlier, the idea behind the life stage model is that younger members can stomach a little bit more risk. They can stomach more volatility as you have a long time horizon. So even though we know market cycles go up and down, even if there are times where we experience terrible market conditions, such as the first quarter of 2020, and we're seeing negative returns, younger members do have the time to stay invested and to enjoy that recovery. So the idea between the construction of some of these portfolios are that we know from investment theory, the higher the risk, the higher the return. So the younger members, because they can stomach this volatility, should really be invested in a riskier portfolio, as over the long term, this risky portfolio will result in higher returns and really a higher value that you're able to retire with. So if you look at risk on the horizontal axis, the further right you look, the more riskier portfolio is. So you'll see that very far on the right-hand side is where you have your 70 portfolios, as well as your member investment choice portfolios, some of your single managers. A little bit more to the left, you have your 60 and 50 portfolios that have 60 and 50% invested in equities respectively. Then even more to the left, you have your 40 portfolios. These are the portfolios that members would be invested in. And then, of course, the lowest risk portfolio is the money market portfolio, which is simply a cash portfolio. We don't expect much risk from this portfolio at all, but also over the long term, you don't expect these big inflation plus beating returns if you're just simply investing in cash. So let's have a look at 2021. So if we think back to the year that was 2021, it most definitely wasn't as eventful as 2020 when we first heard of this new pandemic, but there was quite a few key events nevertheless. And you could summarize the year of 2021 as the year of recovery. Things started to get better, and it definitely showed in terms of the returns that we saw in investment markets. So starting off at the beginning of the year, we started off on a positive note, especially with regards to the pandemic, with the fact that vaccines were now manufactured and available, and testing had taken place. And some of the developed market countries, such as the United Kingdom, had already started rolling out their vaccination campaigns already in December of 2020. So starting off 2021, these developed markets have started their vaccination campaign. So that was all positive, and world leaders across the globe were coming forward to say, absolutely, vaccination is the answer. This is the way forward. This is the only way we will see an end to this pandemic. Locally at home, we started vaccinating a little bit later on, but in February, we had our budget speech. At the time, Tito Mboweni was still our finance minister. And as you know, in every budget speech and pretty much every speech we hear from any of our politicians, we always seem to be saying the right things, but are a little bit short on the implementation side. So he spoke about growth, but he spoke about the fact that our lack of electricity and Eskom really is hampering our growth prospects. And that was the case in February of 2021, and unfortunately, it's still the case now. We also saw all over the globe people going crazy for cryptocurrencies and Bitcoin again. So it was a very volatile year for Bitcoin specifically and other cryptocurrencies. And Elon Musk was one of the people that every time he decided to, post a tweet on his account, he would actually move the whole market. So there was times where he would highlight the risks, such as how much energy usage Bitcoin uses, but it definitely was a year where, again, cryptocurrencies were very topical. A lot of American money specifically was flowing into, this sector of the market, if you want to call it that, which really drove up the price. This was also driven by the fact that in these developed economies, people got a lot of support. So although they may have been under lockdowns and sitting at home, the governments were supporting, putting a couple of $1,000 into their bank accounts, and those people would use this money to then invest into markets, which drove up the price of equity markets, but things such as cryptocurrencies as well. There was a lot of talk about inflation, and that's still the case. So the Fed kept coming forward to say this inflation is transitory. It's just, a period that we will go through and then it will lower. Unfortunately, inflation is still high in the United States. So inflation became very topical. And the reason why this is quite a big deal is, of course, inflation does cause bond yields to go up. When you have high inflation, you have the expectations that interest rates will rise, which has a knock-on effect on markets. America being this big powerhouse of a investment destination, what happens with interest rates there definitely affects the rest of the world. And that's why this topic of inflation, and every time the Fed came forward to say something, affected markets. We also had the Delta variant. So the Delta variant, when it started spreading around the globe, was quite a scary time and a scary situation, as it seemed that this variant was a lot more infectious, a lot more people were dying. We saw, some terrible footage from India. Then we experienced it ourselves in the South African winter, where, the third wave of the South African pandemic was so much higher. We saw, a lot more deaths, very, very strict lockdowns again. And as Dr. Anthony Fauci said, the Delta variant really was, at the time, the greatest threat to us not being able to end the virus. And then inflation kept being a problem in the United States, so much so that even the president, Joe Biden, came forward to calm markets and to say it's highly unlikely that it's going to be long-term inflation that's going to get out of hand. They kept saying that this is just transitory, it's just a point in time, and inflation would stabilize. And then China, very topical, as we do invest in emerging markets. China has this goal of common prosperity for their people. So they really want, the majority of their population to be, middle-class citizens, to do very well for themselves, to have homes, and really, in simple terms, exactly what the slide says. They want common prosperity for their people. But as much as this is very positive over the long term, as we know that whenever a middle class population grows, this is really positive for a GDP perspective. It really is the middle class that consumes. So a country that has a growing middle class will have positive GDP growth over the long term, and it really makes it an attractive destination to invest into. But despite this long-term goal that they have of common prosperity, in 2021, they also put a lot of regulation in place. And these regulations, unfortunately, were regulations that affected the tech stocks. And these tech stocks, unfortunately, from a share price perspective, tumbled. They caused a lot of volatility in the markets. It affected the performance of not only China, but the broader emerging markets indices. And it even affected some shares on our very own local market. So if you think about Tencent, for example, Tencent is a big tech firm in China. However, Process and Naspers, Process owns a big portion of Tencent. So when the Tencent share price went down, it affected the Process share price as well. So it affected our very own market as well. So some of these regulations that were put in place were regulations that ultimately, China believes will benefit their people, but they did hurt these tech stocks. It was things such as restricting the number of hours that miners can spend on gaming. So, they can only spend 1 hour on a Friday, 1 hour on a Saturday, 1 hour on a Sunday, so 3 hours a week on these, gaming platforms. And they restricted, for example, the amount of money that the online education sector can charge. So all of these things to essentially protect some of their people, but of course it did affect the share prices. The problem with regulations in China when compared to the rest of the world is that in the rest of the world, we kind of, hear about the intention to regulate a certain sector. There's a lot of talk, there's a lot of speculation of how this is going to go. And by the time that some type of regulations or taxes are put in place, the market almost expects it and has priced it in. Whereas China, it can happen from one day to the next. It's a big shock in the market. It happens really quickly, the speed of these regulations. And it does cause a lot of volatility in the markets. Things are looking better. So over the long term, still a very attractive investment destination for this reason that, firstly, they have some phenomenal stocks. They own a lot of the patents in the world, or their companies, Chinese companies own a lot of the patents in the world. So really innovative companies there. There's growth in the middle class. So over the long term, definitely an attractive investment destination. We do believe that some of the worst is over in terms of what we saw last year. So it wasn't just the regulations around tech, but they also had a bit of a property crisis as well as growth that was constrained. Whereas, where we are today, looking at their Q4 GDP numbers, they were better than expected. They have lowered interest rates for the first time in 2 years, which is very supportive of the economy. And overall, things are looking a little bit more stable. We can expect more regulations. These regulations could potentially be targeting another sector such as healthcare, maybe not tech. So we do expect regulations to continue, meaning that we do expect volatility to continue. But from valuation perspective, China is the cheapest it has been relative to developed markets in 20 years. So really attractive from a valuation perspective. This might not be the bottom. It may still go a little bit further, but at these levels, it really is attractive. And ourselves, as well as a lot of other asset managers that we speak to, have actually used this as an opportunity to top up the Chinese exposure in the portfolios. And then climate change. Climate change has been very topical for a number of years, but in 2021, it was again highlighted as to how important it is and how we really need to take action now. So we had the G20 Summit as well as COP26 that took place. And as much as the Italian Prime Minister Mario Draghi, that's pictured here, seems to think that the G20 was a massive success, unfortunately, China and Russia did not rock up at the G20 Summit. China being, one of the worst polluters in the world, using 4 times more coal than the next worst polluter. So without these big polluters even pitching at these summits, unfortunately, how much of a success can it be? Then COP26 took place, with countries having to really commit to what they will do going forward with regards to reducing their carbon footprint. We do believe that this will continue to be a theme for a very long time. It's a very serious matter. And again, the way that this impacts portfolios is we have to be increasingly more cognizant of ESG in the portfolios, which we of course are. And we do take quite an active approach when it comes to ESG in the portfolios. So this will continue to be a very topical and important matter. And then the Omicron variant came, as if the Delta wasn't enough. The year continued to provide surprises, and the Omicron variant that was first discovered by the very clever scientists in South Africa started to spread around the globe. In November, it caused a lot of panic everywhere, as at that stage, all we knew is that this is very infectious, but there was not enough data to really say whether it's more dangerous. So it was quite scary to think this virus is really spreading so fast. The vaccines don't really seem to be working. People, especially in developed countries that were double, some triple vaccinated, were still getting infected. So a lot of concern and panic around the world. And you'll remember that South Africa was immediately put onto red list. Nobody wanted to travel here. Nobody wanted to accept people from here. And what that did to the market, specifically in November, if you look at this diagram on the left-hand side, is we just saw red in the markets. So when it's a very risky time in the markets, you see people panicking, and it really was very much a risk-off kind of environment, with all of your riskier types of asset classes that you see on the left, your global equities, UK equities, all your risky type of asset classes giving you negative returns, and only really the safer type of asset classes like cash and US treasuries that provided positive returns in November. Luckily, where we are now is the experts are saying that the Omicron variant is actually a really good sign. We saw that the death rate is not nearly what it was with the Delta variant, as much as it is more infectious and it spreads a lot quicker. And what the experts are saying that, viruses tend to lose steam as they mutate more and more, so they do become more infectious but less deadly. So everybody's hoping that that is the case. Of course, there is still a risk that a new deadlier variant comes around, but the base case is that if there is another variant, it will likely be not as deadly, and hopefully we can get on with our lives and forget about very strict lockdowns and seeing this in the investment markets. But not all is well at present. There's also tensions between Russia and Ukraine that are causing a lot of nervousness in the Eurozone. Now, Russia supplies a huge percentage of the gas to the European Union. So these tensions really could cause an oil shock in the markets. And the markets, of course, don't like an oil shock. You need you need the energy supply to carry on. So if anything too serious, and if Russia actually had to invade Ukraine, it would cause a lot of volatility in the markets, and we would see quite an impact on the whole Eurozone, on the whole Europe region. So that's one of the big risks that we see in the markets at present. So currently, as we start off the year 2022, The biggest risks that are top of mind for us at the moment is one, geopolitical risk, specifically Russia invading Ukraine. Number two is we know that inflation is high. So as much as the whole of last year, or from the middle of last year at least, America kept saying that this inflation will be transitory, inflation is at a 40-year high in the United States, sitting at 7%. So it seems to be sticking around for longer. The Fed will be hiking interest rates. 3 interest rates are priced in for this year in America, starting the middle of 2022. But the risk is that the Fed does hike a bit too quickly. So we don't believe that will happen, but that's one of the risks. And then the third risk, as I mentioned already, is as much as we do believe that the worst of COVID is behind us, of course, anything can happen. And as much as we don't believe that's the base case, there is the possibility that a new deadlier variant comes around and catches us all by surprise. But having said everything that I have about 2021, it was quite an eventful year, but despite that, it was the year that we saw a recovery in the markets. So if you look at what I'm showing you on this chart, we see that every single asset class across the globe was positive. So it was a good time to be invested in markets. Yes, as always, some asset classes do better than others, but it was a good time to be invested. So let me highlight a couple of these asset classes for you. Firstly, the 2 yellow ones that have been highlighted are 2 commodities that have done phenomenally well, and that's oil and copper. Then the greenish blocks that have not done so well, still positive, but closer to the top, so smaller returns. If you look at the returns on horizontal axes, the bigger the bar is to the right-hand side, the better the return. So we see that global bonds, cash, gold, which we don't invest in. So we don't invest into global bonds, we don't invest into gold. Local bonds, despite being positive and a really good asset class, not as great as some of the equities, and Japan. So these are some of the, despite positive, some of the worst performance. Then in red is what we have is these are our global satellites. Now I'll cover the construction approach again a little bit later on, but essentially in the global portion of your portfolio, we have these thematic satellites, and these are really themes that we believe in for the long term, and I have highlighted them in red. Now, what we can clearly see is that some have done better than others, so not all of our satellites perform phenomenally well, but most of them actually did. So if you can see where my mouse is, this blue line, the MSCI All Country World Index in Rand, this really is how did equities do. These are both developed and emerging market equities. So this blue line can be seen as the benchmark of global equities. And now we can clearly see that 2 of the red lines, two of our thematic satellites have underperformed this benchmark of global equities, and the other 4 have outperformed. So the ones to underperform, no surprise that emerging markets is there. The largest component of emerging markets is China. I spoke about the difficulties that we experienced in the Chinese markets, these tech regulations, this property crisis, this concern around growth. So that, of course, did affect China and emerging markets in general. So that was the worst performing satellite, despite still providing positive return. The Fourth Industrial Revolution Fund. Now, the Fourth Industrial Revolution Fund is essentially tech and innovation stocks. What happens when you have high inflation, bond yields rising, the fear of an interest rate hiking cycle, which is starting to happen, is growth stocks tend to do worse than value stocks. This is because growth stocks are valued on a lot of these future earnings. And when you have higher interest rates, those future earnings are discounted at a higher rate, making them worth relatively less today. Now, the Fourth Industrial Revolution Fund is not just growth, but you can almost see it as hyper growth, as these are innovation stocks. So they do get heavily affected by this rising interest rate environment. And because we continue to be in this rising interest rate environment, we do think that the Fourth Industrial Revolution Fund for this year anyway will continue to underperform, still provide you good returns. It will still be It's still global equities, and we do believe it will be positive, but we do think that other pockets of global equities will do better. But over the long term, it's still really attractive. It's really these revolutionizing the way we're going to live our lives. Remember that in this fourth industrial revolution fund is where you have exposure to space, to artificial intelligence, to distributed ledger technology, even to clean tech and clean energy, which is very topical. So these companies are at the forefront of the fourth industrial revolution. And as much as from a style perspective, growth stocks don't do so well in a rising interest rate environment, over the long term, they definitely have a good place in the portfolio. So we will continue to invest in them. Then the others have done very, very well. So healthcare, we can see that this red line is above the MSCI All Country World Index, so done better than the benchmark of global equities. So healthcare has done really well. Now, healthcare has been a theme in the portfolio. We do believe in healthcare going forward as a theme, not only due to the pandemic and the vaccinations and, you know, the profits that some of these pharmaceutical companies are making due to, you know, being the pioneers of these new vaccine technologies. But even looking beyond that, there's a lot of innovation in the healthcare space, aging population. So there's many, many reasons why we continue to believe in healthcare as a theme. And it has rewarded us already. Then S&P value. Now, this is more of a shorter term satellite that's in the portfolios. Now, value is essentially the opposite of growth. So everything I said about growth in the fourth industrial revolution fund, value tends to do well in a rising interest rate environment, which is exactly why we included it in the portfolio last year. As when you see this high inflation and we've had all these interest rate cuts, you know that we will be entering into the interest rate hiking cycle. So we added value to the portfolio, which performed phenomenally well. We don't invest into global bonds. So for that reason, we have some global property exposure, as global property can be seen as an alternative to global bonds, and that has done really, really well. And then, of course, in some of the portfolios, there's exposure to the FANG stocks, which have also done really, really well. So we know that markets were predominantly positive, or pretty much every asset class was positive for the year of 2021. So now let's have a look at how this has translated into the performance of your portfolios. So what we can firstly see as an observation is that all numbers on the slide are positive, which is great to see. But focusing specifically on the 1 year, if we really want to look at what was 2021 all about when it comes to portfolio performance, looking from the top to the bottom, we can see nice double-digit returns for all of the portfolio ranges across the board. Most members would be invested in the 70 portfolios, as we know that most members do default into the life stage model. And we can see that the Signature 70 provided 21.3% return for the year. The Skeleton, being the passive option, 19.4%, and the Synergy was the best performing from the 3 lifestyle ranges for this year, giving us 24% for the year. All of them ahead of their strategic benchmark, which was 18.2%. Now, if we look at some of the more granular detail of the way what returns markets gave us for the year of ending 31 December 2021. Again, if you look across the board, as we saw in that other slide, returns have been positive across the board. Now, a few numbers to highlight are firstly local equities. Now, there was quite a difference between the SWIX and the capped SWIX in 2021. In the Signature and Skeleton portfolios, we track the SWIX index, so the shareholder weighted index, and we continue to be of the view that it is the better or the more suitable index to track in your portfolios. The reason that there's quite a difference over the 1 year in performance between the SWIX and the capped SWIX is the capped SWIX was really created to reduce the exposure to NASPers. So NASPers was initially capped at 10% of the capped SWIX index. So in the capped SWIX, you have lower exposure to stocks as they are capped at 10%. Now, corporate action took place in August of 2021, where Prosus bought a whole bunch of NASPer shares, and Prosus essentially became bigger in the index. And then the JSE came forward to say they will cap both Prosus and Naspers at 6% each in the capped Swix, effectively giving you 12% exposure to Naspers and Prosus as a whole, or another way to view it, giving you 12% exposure almost to Tencent in China. In the Swix, there is a higher exposure as there's no capping that has taken place, although this gap has narrowed quite a lot. But essentially, I mentioned everything that happened with regards to tech stocks in China affecting Tencent quite a lot. So now you have your Swix index that has a high exposure to Naspers and Prosus that had a high exposure to Tencent. So those were more affected, or that index was more affected by the negative news in China than what the capped Swix was. If you look further to the right over the 5 and 10 years, the Swix definitely has performed better. And you see that over the shorter term, that gap is closing as well. We continue to be of the view, as I mentioned, that the Swix is more suitable, and we will continue to track the Swix in your portfolios. The Swix does have a lower turnover, which means lower transaction costs, which ultimately impact the total investment charges of the portfolios. And the other reason is that the Swix gives you a higher offshore exposure. And now with the already limited, amounts that we can take offshore with regards to Regulation 28, you do want that, higher exposure to companies that derive a lot of their income from outside of South Africa as well. The second thing I want to point out is the performance of South African listed property. You can see a great return there of 36.9% over the year. This really is due to coming off a low base. So in 2020, property was one of the worst performing asset classes, down more than 50%. So it has rebounded quite nicely. That coupled with the fact that interest rates have remained low in South Africa that make this property sector attractive. And purely from a valuation perspective, these property stocks had fallen so far into the red that, people started buying them up as they were looking attractive from a valuation perspective. If you look further to the right, you'll see that over 3 and 5 years, still a negative returning asset class, and property, has really struggled over the long term. So it really is more of a short-term bounce that we have seen in the markets. Now, the portfolios don't have exposure, so your signature and your skeleton range don't have any direct exposure to property. So, and we continue to hold that view for the moment. So relative to some of the competitors that we will see in the surveys, they have that better over the shorter term because they've had exposure to property, but over the long term, it definitely has benefited the Sygnia portfolios not to have exposure to property. And then I already mentioned that China did struggle last year, a lot of volatility, regulations, property crisis, growth concerns in China. So we can also see that there was quite a big difference if you look at global equities, how the developed market did relative to emerging markets being largely driven by the performance in China. Over the long term, it's always nice to see how your portfolio has done over the long term. So what we're looking at on the slide is how 100 Rand invested once, 10 years ago, back in May 2012, how this 100 Rand would have grown through the years. Now we can clearly see that whether this 100 Rand was invested in Signature, Skeleton, or Synergy 70 fund, that it has grown really nicely, not without volatility. So you're not seeing the smooth growth, you're definitely seeing the ups and downs along the way, which is exactly what you expect when you're investing 70% of the portfolio in equity markets. The black line is the median performance of the managers listed at the bottom. If you have a look at some of the names, these are very well established, very well known asset managers with a lot of experience in managing retirement fund money. So it's well accepted in the industry that if you can beat this black line, then you've done better than the average retirement fund. So we can clearly see that all three of these portfolio ranges over the long term have comfortably outperformed the global large manager watch median, with the best performing being the Signature 70 over the long term. Looking at the surveys, so these surveys are prepared by Alexander Forbes Investments, and they compare like-for-like portfolios, so in different categories. So on the slide in front of you right now, we have the low equity multi-manager survey as at the end of December. Over the last 6 months of 2021, we can see that the Synergy 40 fund was the third best performing, followed by Signature 40 closer down, and the Skeleton 40, the passive one, being closer down to the bottom. So 2021 was definitely a good year for active management. So active managers were able to add value. We do know that they charge higher fees. These surveys are gross fees, so fees have not been deducted. On a net fee basis, the Skeleton fund would move higher up. Over the 1 year, the Synergy 40 fund somewhere closer to the middle, with the Signature 40 a little bit further down and the Skeleton 40 second from the bottom. Over 3 years, we can see that the Signature and the Skeleton 40 funds have been the best performing, and the Synergy 40 fund somewhere down the middle. And really always important with any retirement fund portfolio to focus on the longer term numbers. We can clearly see that over 5, 7, and 10 years, these portfolios have been the best performing when compared to similar portfolios in the market. Looking at the low to medium equity multi-manager survey, so all of these portfolios have an equity exposure of around 50% in equities. We can see over the 6 months that the Synergy fund at 9.7, closer to the middle or the bottom of the rankings, with the Signature and Skeleton at the bottom of the ranking tables over the shorter term, over the 6 months. Same situation over the 1 year. But when you extend that period and you're looking at the performance over the 3 years, we see that the Signature 50 fund is the third best performing, the Skeleton somewhere in the middle, and Synergy just below that. And over the longer term, really good performance, especially over the 10 years. The Signature 50 fund has been the best performing, followed by the Skeleton 50 fund. Over the long term, you'll see that there's less competitors, so less bars that are included in the survey. You have to have an actual track record to be included in the surveys. The 60 fund was roughly 60% allocation to equity. Also in the medium, this is in the medium equity survey, we can see over the 6 months and 1 year that all 3 of these portfolio ranges are relative to competitors or closer down to the bottom, but over 3, 5, 7, and 10 years, these have been the best performing portfolios. And then the most important one is the 70 portfolios. Why I say these are the most important is we have seen from the data from employers that most members spend the majority of their working lives being invested in these portfolios, especially because most default into the life stage model. So right up until 6 years before retirement, members are invested in these 70 portfolios. Now, the reason for the underperformance across all the ranges, but I'm touching on it here, is really due to the lack of exposure of our Signature and Skeleton range to property. So we don't have any exposure to property over the shorter term. That's why over the 1 year, we, relative to competitors, have done a little bit worse on a relative basis, despite the fact that these portfolios have actually done really well. They've had inflation beating returns. They've beat their own benchmarks. So it's just on a relative basis over the shorter term. And these portfolios are also less risky than some of these competitors. So we are a little bit more conservative on investing in equities relative to competitors. So being less risky, as we've had less exposure to local equities, for example, and local equities, we did see they have done quite nicely. Of course, the portfolios that took on more risk did better over the short term, but over the longer term, it has served us well to avoid both property and to be slightly underweight SA equities relative to the others. So looking at these portfolios again over the 6 months, we can see the Synergy fund closer to the middle or the top half of best performers, the Signature 70 fund closer down to the bottom, and the Skeleton fund, the worst performing over the 6 months. Over the 1 year, similar situation with the Synergy 70 fund somewhere closer to the middle, and the Skeleton and the Signature 70 fund at the bottom of the ranking tables. But over the 3 years, where property was a negative returning asset class, it has paid us, for example, to have avoided that negative return. We can see that over the 3 years, we can see Synergy and 70 right up there with some of the best performers. And then more importantly, especially for the 70 portfolios, it really is important to be focused on the long term. As I mentioned, members are expected to be in these portfolios for the long term, and we can clearly see, top performance across the 5, 7, and 10 years. with the Signature 70 fund being the best performing out of all the competitors in the survey over 10 years. The way to look at these longer term numbers, these are annualized. So looking at Signature 70 over the 10 years, for example, this return of 13% is a gross return, so before fees have been deducted. And this return, if you had been invested in the Signature 70 portfolio for the last 10 years, your return would have been 13% per year for the last 10 years. And then the last thing, to look at when we're comparing ourselves in the surveys is to stack up against the single managers. Now, not necessarily a fair comparison, as some of these single managers are actually in the portfolios, but interesting to have a look at the performance nevertheless. We can see that over the 6 months, 91 and Oasis were the best performing managers, but then Signature 70 is right up there, the third best performing. The Synergy 70, Signature 70, some are closer to the middle, underperforming some of the asset managers, but also outperforming a lot of the asset managers. And the Skeleton Fund, despite it being totally passive and lowest cost, has still managed to outperform Allan Gray, Stanley, and Ford over the 6-month period. Over the 1 year, not too different of a story, with a couple of the asset managers doing really, really well. Synergy 70 right up there with some of the best performers, but even the Signature 70 fund, despite it being more closer to the middle, still managing to outperform Allan Gray, Sunlab, Stanley, and Ford. Over the 3 years, it's only really Coronation that has managed to outperform Synergy and Signature, and all the other asset managers are at the bottom. Over the longer term, over the 5 years, again, it's only really Coronation that has managed to outperform. Over 7 years, the Synergy 70 fund has outperformed everybody. And over 10 years, it's only really Coronation that has outperformed by only 0.1%. They have outperformed the Signature 70 portfolio. I remind again that these are gross fees. The Signature 70 portfolio is still relatively low cost, as it is a blend of active and passive, passive being there to really bring down the cost of the portfolio. So on a net fee basis, no doubt that the Signature 70 portfolio would be sitting above Coronation over the 10 years. So really interesting to see that active managers actually have struggled relative to these very well diversified, multi-managed portfolios over the long term. And then it's all good and well that we have a look at the returns of the portfolio, but it's also important to have a look at the risk. Now, I already mentioned the risk. I mentioned that we have been more conservative than some of our competitors, which means that we have performed, a little bit worse than them over the 1 year. But over the long term, it definitely has paid off to be more conservative, and the portfolios have taken on less risk. This was actually evident in 2020 when the Sygnia portfolios were sitting at the top of the ranking tables. So taking on less risk really paid us. We lost a lot less money than everybody else in that difficult period of Q1 2020. Now, having a look at the range, you've got your Signature range here in the dark red. You've got your Skeleton in these squares that are a little bit lighter red, and then this almost pinkish color shows us the Synergy range. So it can get a little bit busy, but essentially you have risk on the horizontal axis. So the further right you look, the more risky a portfolio is. A portfolio is a lot more risky when it invests in riskier asset classes. So the more equities that you have, the more global equities, the more alternative investments, the more hedge funds, or the more property you have, the further to the right this portfolio will sit. And then you've got your return on the vertical axis. So for every level of risk, you essentially want the top performing portfolio. So I'm not going to cover every single portfolio. I will simply focus on the 70 portfolios, which are the portfolios where we expect members to spend the majority of their working lives being invested in. And we can see that Synergy 70, for about 10% of risk measured by standard deviation, has been the best performing portfolio for this level of risk. The Signature 70, taken on a little bit less risk than Synergy, has been the best, or one of the best performing portfolios for this level of risk. You could argue that, Coronation and Alexander Forbes Performer are sitting higher, but for this level of risk, every portfolio that plots right underneath Signature 70 has basically taken on the same amount of risk, but simply not delivered as high of a return. And then the Skeleton 70 fund, which is a little bit further down, For this level of risk, it has also done really well. Everyone plotting underneath it has taken on the same amount of risk, but simply not delivered as high of a return. And this is measured over a 7-year period. And all of these portfolios that are sitting to the right have taken on more risk, they're further to the right, but simply had not delivered as high of a return as your Synergy and Signature 70 funds. So they have not been rewarded over the long term for this excess risk that they had taken. So overall, the portfolio ranges have done really nicely for the level of risk that they have taken relative to competitors. And then the last thing on the agenda for today is really to look at the portfolio positioning, your portfolio construction approach, and how we have positioned the portfolios for the year ahead. Now, the portfolio construction approach that we follow, especially in the Signature and the Skeleton ranges, is what we call a core satellite portfolio construction approach, where if you look at this diagram, you have your core of the portfolio and you have a number of satellites. Now, this portfolio construction method is really designed to minimize costs, as it does blend active and passive in a really suitable and beneficial manner. So it's designed to minimize costs, to reduce volatility, so reduce the risks of the risk of the portfolios, but still providing you with that opportunity to outperform the benchmark. So this core satellite approach really can be seen as the best of both worlds, or the best of all worlds approach, where you can get better than average performance, so giving you that opportunity, as I mentioned, to outperform, but still minimizing volatility. And by adding all of these thematic, satellites to the portfolio, it also provides greater diversification. Now, the better diversification also is a risk reduction strategy. So the way we think about the portfolio construction is really at the core, you've got your mostly passive traditional types of asset classes, and then your satellites, these can be active or passive, but these are really the themes that we want to get exposure to in the portfolio. So this is how we think about the portfolio construction, especially when it comes to the Signature and the Skeleton range of portfolios. Now, this portfolio construction method can be thought of as a whole portfolio, as well as within each building block. So if you think about the equity building block of the Signature portfolio, for example, you could also view, the construction of that equity-only building block in a core satellite approach, where the core of the portfolio is passive, you're tracking the SWIX, and then you have a number of active managers such as Coronation, 91, ABAX, and Visio that act as your satellite, and these are the active managers. So that's at a building block level. But at a whole portfolio level, we're also following, this portfolio construction approach. So thinking about Signature and Skeleton 70, for example, at the core of your portfolio, you've got your more traditional asset classes, as I mentioned. So you've got SA equities, SA bonds, global equities, and global bonds. These pluses and minuses show you our current positioning. So as I mentioned, we're slightly underweight SA equities, relative to our own strategic asset allocation, as well as relative to some of the competitors that we saw in the surveys. Now, we still, as much as from a valuation perspective, a lot of South African equities are looking very attractive. We do still see a lot of risks in the South African market. We've seen the Zondo Commission report come out, highlighting a whole lot of, problems, corruption, and it's really the way that South Africa deals with this, inquiry, these reports that will be key. We've seen, Eskom will continue to be a problem for growth. Eskom is proposing tariffs that, of course, will affect the profitability of South African companies. Unemployment is at an all-time high. And until we see some type of a positive catalyst, we're not quite ready to go to even being overweight South African equities. So just to make it clear, it's not to say we don't invest in South African equities. It still is our largest exposure. And just that relative to our strategic asset allocation, we're slightly underweight. We overweight South African bonds, so we still think that the risks are very well priced into South African bond markets. The South African bond market is providing some of the highest real yields in the world, so we're still holding that overweight position in South African bonds. On the global equity side, a lot of diversification opportunities. So we overweight global equities. So we'd rather, favoring the global equity to the local equity side, and we're still not investing in global bonds. Because we are not investing in global bonds, I mentioned a little bit earlier that global real estate can be seen as an alternative to global bonds. We saw when we looked at that summary of how 2021 delivered, that global real estate has provided really good returns to the portfolios. It has done really nicely, and we continue to hold that position. These little pluses that are included in the satellites are an indication of this kind of overweight position in these satellites. So we overweight global real estate. Disruptive technologies. This is, your fourth industrial revolution fund exposure. Despite it not doing as well as some of the other equities over 2021, we still think that over the long term, this portfolio is very well positioned to take advantage of all the innovations and all the changes that we're seeing in the globe with regards to tech and innovation specifically. Then emerging markets, so the exposure to China, exposure to other Asian economies and emerging markets in general, very overweight. So you can see, quite a number of those four little pluses there. So we've got quite an overweight position to emerging markets. Emerging markets are really where we're going to see the best growth over the next couple of years, a lot of innovation, there's growth in the middle class, and many, many reasons why we find emerging markets attractive. And from a valuation perspective, as I mentioned, we did use the volatility in China. And the fact that valuations at the moment are looking so attractive, we have used that as an opportunity to top up our exposure. Health, big theme, has done really well in the portfolio. So health continues to be a very important theme, and we continue to hold this overweight position in health innovation. So you've got a health innovation fund as well as a healthcare ETF in the portfolio. So it's global healthcare exposure, specifically focused on developed markets, as these in developed markets really are the companies that have a lot of funding for research and development, and these will be, the front runners of any innovations that are taking place in the healthcare space. And then value is more of a shorter term kind of play in the portfolio. It is a satellite or a thematic exposure that we have included due to this rising interest rate environment. So value really is an investment style. A value index is comprised of stocks that have lower price to books and price to earnings ratios relative to others. So these are attractive stocks from a valuation perspective. It's typically more of your blue chip companies, your dividend paying stocks. And value has performed really nicely. We continue to be in this rising interest rate environment with countries such as the UK already starting on the interest rate hiking cycle. South Africa has already risen interest rates as well. So value will continue to be in the portfolio, although not as longer term theme as some of these others, such as healthcare, such as emerging markets and disruptive technologies. And then overall, we still have this tactical asset allocation overlay. So we do make tilts to the portfolio, depending on the current market environment. So looking at the strategic asset allocation of the portfolio, your 40 portfolios have roughly 40% exposure to equities. So if you add up the South African equities and the global equities, you'll come to 40%, whereas in the 70 portfolios, you have that roughly 70% exposure to equities. And then on a shorter term basis, we do tilt the portfolio. So we're currently underweight SA equities, overweight bonds, overweight global equities, all of those positions that I showed you. In the signature range, we're using a blend between active and passive. So you have your passive components as well as your active managers managing South African equities. It's really on the global side that you're seeing a lot of this thematic exposure. So here you'll see value, you'll see emerging markets, China, you'll see the global property, the health innovation. So this is really where you see your thematic exposure taking place. The skeleton range, exactly the same on the offshore side. where you see a lot of those themes playing out, and you're not seeing any active managers, so it's a totally passively managed portfolio. And in the synergy range being managed by the local asset managers, where they decide the asset allocation on the local side, so they decide the split between local equities, properties, cash, etc. And on the global side, you still have the passive components being managed by Sygnia, so you still have exposure to all of those exciting thematic satellites. So that's how we have positioned the portfolios for the year ahead. As I mentioned, we do see some risks, such as the geopolitical, interest rates rising too quickly, but we do believe that growth will remain above trend. We do think that equities will continue to do well. In this current environment, growth will continue to recover. So we'll continue to see some good returns from both local and global equity markets. So that takes us to almost the end of the hour. I want to thank you all very much for listening to me today. If you have any questions over the next minute or two, please pop them in the question box, and I will do my best to answer them. There is one question here that says, given the context provided and the reason for Sygnia's underperformance over the short term relative to peers, even though they have beaten their own benchmark, which is understandable, do you think clients could be reviewing their investment strategies between defaults of skeleton, signature, and synergy respectively due to the short-term numbers, based on the fact that these shorter-term numbers will creep into the longer-term numbers, or continue to believe and stick to the long-term strategy? Look, I believe that if clients are getting the right advice, either from their own employee benefits consultants or from the services of an investment consultant, they should, in a retirement fund context, always be focused on the longer term. So I don't believe that 1 year relative underperformance will necessarily result in the change of investment strategy. Although if we continue to see this trend, come this year, come this, next year, they may then start making changes between the skeleton, signature, and synergy range. The skeleton range, we've seen a lot of data where if you look over the long term, it really makes sense to be invested in low-cost passive solutions. Unfortunately, not every year is the year for passive. In 2021, it was quite clear that active managers actually added value in the portfolios. But for those, management committees that still believe, and we continue to believe that passive makes sense over the long term, especially on a net fee basis, despite the relative underperformance of the skeleton range relative to signature and synergy, over the long term, it really will be beneficial to have a portfolio or a range of portfolios that cost as little as possible to provide members with a great likelihood of having those inflation beating outcomes over the long term. I'm not seeing any other questions in the question box. If you do have any others, please do email them through and I will get back to you on email. So it's 1 minute past 10, so the hour is done. I want to thank you all for joining me for the first SURF webinar of 2022, and we will see you next month. Thank you.